Yeah, man. That's like I was at WeWork the other day. We were shooting, and I'm shooting a commercial, and we're doing it video by video, and one of the videos had no audio, but we didn't notice until I got back home.
Yeah.
Pissed.
Was that the one that I saw? I think you were in some type of apartment complex or something.
That's my office. So whenever I'm not working from home, I'll work down at the WeWork building.
Okay, okay,
Yeah,
okay.
yeah. So I rent some
Nice.
space there and do some videos and stuff there. But yeah, it was that one.
What'd y'all do? You did a voiceover for it, or?
No, it happened to not be needed in the shot, so I just
Okay.
left it out.
Yeah,
I was
yeah.
like, fuck it, whatever.
Yeah, that's crazy.
Yeah.
With all this content stuff
For real.
that we're doing now as entrepreneurs. Like
Got
before,
to.
the concept of entrepreneurship,
Mm-hmm.
to me, in my eyes, it didn't include the content creation process.
It never did. It never did.
Now
but-
it's a must.
And now it's an absolute must. Like, you have to let people know who you are, because the thing is, there's a lot of people out there who may not even be as good as you are at your craft. But if people know them, they're gonna want to gravitate and work with them, than work with you.
Yeah.
So you really have no choice but to put yourself out there and let people like gravitate to you. You know
Yeah,
what I mean?
absolutely.
So tell me about what you got going on in the real estate space right now.
So now the core focus has been on building up the business. Not necessarily focused before. I was more agent centric, trying to build up my personal productivity.
Right.
But I've really been pushing towards a lot more towards buying my time back and creating an engine that is actually running without me.
Absolutely. That's the way to go, man. That's
So-
how I am with my car rental business, and also with my credit repair business too.
Yeah.
You know, a lot of people in credit repair space are kind of like doing everything themselves. And what happens with that is that you're not really doing anything good. You
Yeah.
know what I mean? You're a jack of all trades, but a master of none. So I actually have a disputing team. I have a closer. I have an entire team that handles all the like kind of busy work. So I can focus on really client acquisition, building relationships, and things like that, you know, which are the most important things for like a CEO of a business.
Correct. The high
Revenue,
value.
revenue
task and
generating activities,
responsibilities.
for sure. So you're in the real estate space. So I kind of want this to be geared towards people who are looking to buy houses, people looking to invest in real estate, because I know you invest in real estate too. And you know, I'm in the credit space, and I want to kind of enlighten people on what's possible when it comes to credit.
Right.
Even if you're in a position right now where you got bad credit, you can fix your credit. It's just a matter of time. And I think a lot of people don't understand that really credit is really just a game. There's a lot of people who are fearful, and I'm sure you probably deal with people who are fearful about buying a house.
Right.
You know, like when I bought my first property, I'll be honest, I was a little bit scared because I'm committing myself to a mortgage for 30 years.
Likewise.
You-
I definitely.
Oh, yeah, you just bought a house the other day, right?
Correct.
Right,
Like,
so-
I went through a similar experience where, you know, I would guide people through the process, but I wasn't eating my own dog food.
Yeah.
So I finally got the opportunity to do so, and it was mind blowing.
Yeah. It's definitely a good thing. But the thing about the fear is like it's not real. You know what I mean?
Correct.
It's not. I mean, yes, it's good to be cautious. You don't want to get yourself into something that you can't afford or whatever the case is. But the fear is not real. And there's a lot of fear around business credit and around credit in general, just because a lot of people don't understand how the system works. So the credit system works in a way where you can always replenish your credit, and it could take you anywhere from, let's say, 12 months to 18 months, sometimes even less than that if you have bad credit.
Right.
And you really don't have to pay off the debt.
Correct.
That's what a lot of
Absolutely.
people don't really understand.
Yeah, you can even close on real estate without having to pay off any debt. Even if you have collections accounts,
Yeah?
you can still close on deals.
Yeah.
A lot of people don't know that.
Yeah,
They
okay.
think they can't move forward, or they can't even just process an application without paying that stuff off first.
Yeah.
And then what happens typically with people who have that fear, they, you know, once they go through the process, the recurring theme is like, oh, if I would have known, I would have done it sooner.
Yeah, I hear that so many times because, you know, I had a client one time who, in the credit repair space, right, for the credit repair business, she was on year 6 of a charge-off. Because statute of limitations in Florida is 7 years.
7 years,
So any debt is going to just automatically fall off your credit report in 7 years. She didn't know that. So on year 6, she actually made a payment to the collection company, thinking that it was going to come off of her credit. She was actually trying to buy a house.
Right.
And and it didn't come off of her credit, and she was pissed, but she was also very confused. So when she met me, I told her, I was like, you were on year 6. You did not have to pay that. You could have just went through the credit repair process, and we could have got that off your credit. It might have taken maybe 30 days, maybe 60 days, but you wouldn't have had to. It was a substantial amount of money. It was like $1,500.
Yeah.
That could have went towards your down payment for your house.
Right.
So it was really just about, like, educating people so that they know, especially if you're in the business field, in the business world, there's so many things that you have to kind of learn by trial and error that they are not going to teach you in school. And they're purposely not going to teach you in school because we need a society of workers, right?
Right.
If everybody knew all the little tips and tricks about credit, we wouldn't really have anybody to, be employees. And that's just the way it is. It sounds fucked up, but that's the way it is.
It's messed up.
Right?
It's really messed up. It feels like definitely we were tricked.
Yeah.
Because all the things that we need to apply to not just survive, but to thrive in the real world, right? It's like we totally were opted out of that involuntarily.
Yeah.
So things like that. And then in fact, not only did she do that in year 6, right? But then I think, if I'm not mistaken, you can correct me if I'm wrong, she also basically reinstated the count.
Exactly.
Right? So it could be on there, even though you can still do stuff to get it removed. It could be on there for an additional 7 years.
Correct. And I forgot to mention that. Yeah.
Once she gave that payment up, she confessed to the debt. She owned the debt. Made the payment. Did she pay it off entirely?
No. Well, she made like an agreement, but she didn't get what's called a pay for deletion. So if you get a pay for deletion from a creditor in writing, you want to absolutely get it in writing. You can get the creditor to say, all right, I'm going to remove it off of your credit report, and then they will do it.
Right.
But a lot of people don't really get pay for deletions like that, right? They're not very common, and she didn't know about all of that.
And they're not up on game to request that, because that's something you discuss when you're negotiating the account. Right,
when you have a little bit of leverage.
Right.
So, she eventually went through the credit repair process, but she still didn't have to spend that money. It was kind of like wasted money.
Right.
We deal with people who are looking to buy cars, looking to buy houses, and a lot of times what they don't realize is that if you buy a house and you take the time to fix your credit beforehand, you get it up to, let's say, the 720s even, or maybe even higher, or maybe even in the 6s.
Right.
The amount that you're going to be saving throughout that mortgage on interest compared to the time that you might spend on credit repair, or even the money or the fees that you might pay for credit repair, is crazy when you break it down. Because if you put it into an interest calculator, you'll be able to see how much people are actually paying over 20 years or 30 years. If you have even a 1% difference in your interest rate, you're going to be paying much more over time than having a lower interest rate, even if it's just 1%.
Right.
Does that make sense?
Yeah, it makes perfect sense. But something that I've come to a realization is you can actually commit to buying a house even at a lesser credit score, right? Let's say you're in the 600s,
right?
620s per se, right? And just commit to paying a small amount over your mortgage, let's say $100,
right?
And you can start cutting into your interest rate,
right?
Into your interest to the overall balance that you're going to contribute towards interest,
right?
You can cut into it.
Right.
By just chipping in a little bit more on a monthly basis. It does require sacrifice, and I know a lot of people these days have been very conscious about the monthly payment, and that's actually what's stopping a lot of people from moving forward.
Yeah.
But it's little things like that even if your credit score is not 720 or better, that's a great goal.
Yeah.
To minimize your interest rate, your monthly cost. But you can also pay a little bit more on your monthly obligation, and in a couple of years, when the opportunity presents itself to refinance, or you're ready to make a second purchase or investment, then you can go ahead and pivot with a better credit score, right? Because I used to also encourage people to have higher credit scores and wait until their credit score, or at least in my consultation, I definitely make mention that you'll get access to the better interest rates when your scores are above 720.
Yeah.
But even then, getting your mortgage sooner rather than later would actually get you access to boost your score, because a lot of people are not realistically going to hit over 720 without the use of authorized user trade lines or things of that nature, certain instruments, right?
Right.
That you are an expert in,
Right.
To get them there, right? So, I mean, how do you determine what is the best either product or service to provide them with, depending on their goal?
So the way that I structure things is really, there's two people that I work with. People who have a 720 or above credit score, and people who have a credit score that's lower than 700 or 720.
Okay.
Right.
And this is pertaining to business credit or just in general?
Typically in general, but this is really what I'm speaking of is really more geared towards business credit.
Okay.
Right.
That's what I'm most interested. I'm asking questions.
Yeah.
From the perspective of an interested party for sure.
In the business credit, right?
Yes, absolutely.
Right.
That's my next, as I mentioned to you. That's my next.
That's
next move.
We're gonna definitely touch on that because it's a whole nother world, man. There's so many things that you can do with business credit. So once your score is at least a 720 or above, the banking world kind of opens up to you because you've shown them that you can be a trustworthy borrower. And at the end of the day, the banks must lend money to even create money, because that's how money is actually created. Once you borrow money, it's literally created out of thin air. Money's not backed by gold or anything like that.
Right.
So they want people who understand how to utilize debt in a positive way, put it to work, and then pay them back. Right? It's a win-win for everybody. The bank wins. You win because you create a cash flow for yourself. The economy wins because in order to create that cash flow, you had to create value for others.
Right.
Right. So
you're participating. You're participating in the stimulation of it.
Exactly. So it all works out. But where the issue comes is really just the education, right?
Right.
So I have other clients who are underneath that 720 credit score.
That's me.
All right.
Full transparency.
But I mean, there's no shame in that. I mean, like back in the day, I used to have a 450 credit score when I first started. And it took me a while to really understand everything I could about credit. And I eventually built my credit up to a 750.
What would you say that time span from having a 450 credit score to the level of knowledge and expertise you carry now? What is that time frame?
Well, I would say, so because I didn't know anything about credit, I spent a lot of years not really investing in it or trying because I just didn't know anything, and I didn't believe that it was, you know what I mean?
It was important.
There's things you could do.
So give me two time frames.
So
I want to know from when you discovered it was 450 until you made a conscious decision on doing something about it, and then from when you made that conscious decision to now.
Okay, so to be realistic, there was a lot of accounts that were on my report that were aging. Right. So when I looked at my report, I realized that I had some accounts on there that were like 6 years old. Some of them were like 5.5 years old. So at that point in time, I was like, I could either wait it out or I could go through the credit repair process. Now I went through a bunch of credit repair companies, like the ones where you pay like $100 a month or whatever the case is, and got absolutely no results.
Yeah.
Every single month.
Put on a monthly payment.
Just on a monthly payment, I just wasted a bunch of money.
The infamous. I think that's why the credit repair industry as a whole has such a
negative
negative stigma.
Yeah.
Because of those payment plans.
Well, it's a combination of that, and then it's also, you got to think about it from the banking perspective. They don't really want people to know that technically you don't have to pay your debts off.
Right.
They don't want people to know that there are ways legal ways using the Fair Credit Reporting Act or using consumer law or even using Metro 2 to get these things off of your credit report, because it's not in their best interest.
Right.
So that also plays a part in why the industry has this stigma of it's I don't know if you want to say shady or untrustworthy. That's a better word to put. Right. So that's definitely something that I've learned throughout my process. So to answer your question, my rebuilding process took a little bit longer because I didn't know what I know now.
Right.
So I would say it took me about 3 years, but that was really because I waited for a lot of stuff to just fall off.
Correct. Okay.
Right?
So you were just letting time pass.
I was just letting time pass. But now with what I know now, it can take anybody, anywhere from 6 to 12 to maybe even 18 months, just depending on what's on your credit report.
And
I'm
in
talking,
some cases less.
And in some cases less.
I have seen miraculous things happen in like with one round of disputes.
Yeah.
Within the first round.
It happens all the time. Within the first round, you can get, we've gotten charge-offs, collections, late payments are usually like a little bit more difficult to do, but we get them off as well too. But
especially when the account is still active and open.
Exactly. Yeah. So to answer your question, I the time frame I said before is like, I don't want to sell a dream or like make it seem as though, it can happen overnight or it can happen in 30 days. Yes, it does happen like that at times.
It can.
It definitely can. But is it common? I don't know. Maybe it could be common, but more realistically, you're looking at, 90 days, 3 months, 6 months, maybe 8 months, whatever the case is.
I know, and I ask because now that you are in the position that you're in, obviously you gained a certain level of consciousness behind, all the different methods and strategies, tactics that you can use to help people for the benefit of others.
For sure.
But it may not have taken that amount of time for yourself because you had to go through, signing up for multiple companies to service you.
Yeah.
See that their services didn't work.
Yeah. Try another one.
See what letters they were processing. And you actually watch the process because you have to sign off on those letters and send documentation. So you kind of got educated through the process of hiring other companies to do it for you.
Absolutely. And, I saw what they were doing good and what they were doing bad. And then in my company, I adopted all the things that I wish that they would have did.
The best practices.
Like, for instance, like we have an app. So if you're a client of ours and you're doing credit repair, we have an app that refreshes every 30 days where you can see all of your credit scores. You can see when the next refresh is. You can see your credit score going from, let's say, a 550 and it's now at a 575, right? There's so much information in there. And then you can also message us and communicate with us directly in the app. So once you're onboarded, you have this nice little app that's just on your phone. Everybody has a phone, but you build a more intimate relationship with your credit score. You can see all the disputes that we're doing. You can see everything that we're doing so that you know exactly what's going on. And then every 35 days, we call our clients and we give them an update.
Right.
Regardless of if there's anything that happens to the account or not, because sometimes we get a lot of things off. Sometimes we might get one or two. But we're always going to call our clients on that 35th day. And I say 35 because it takes about a few days for the bureaus to get the letters when we send them out.
Right.
So on the 35th day, we call them and say, hey, Rob, this is what happened with your credit score this week. This is what we got off. This is how many points you went up. Those kind of things. And people love that because when you engage like another company and you're paying $100 a month, they're likely not doing that. You don't hear anything from them. It's just crickets, right? So yeah, that's kind of been my journey, and I really just want to change lives and open people's mind to like what's possible, because at the end of the day, the most important thing that people don't realize is that time is your most important asset.
Right.
If you can, like you said earlier, if you can get into your house earlier by just cleaning up your credit, if you can get into a car earlier, if you can get business funding for that business idea earlier than having to wait like I did, the 3 years or 4 years for things to fall off.
Right.
That's what it's about.
Exactly.
That's where the value is.
Absolutely. The speed.
Speed. Yep.
Now, when it comes to the business credit and the personal credit, did you decide to, because I know at first, I think I want to say, you could correct me if I'm wrong, you were focused on business credit first and foremost, right? And then you opened up to offering personal credit. Was it to help get more people qualified to do the business credit?
Yeah, and by business credit, we got to kind of clarify, because there's a lot of misconceptions when it comes to business credit. So there's business credit, but then there's personal guarantee business credit.
Okay.
Right? And that's what we teach.
I'm glad you brought that up. Yeah.
That's what we teach inside of my community, because we teach people how to credit stack, how to acquire anywhere from $100,000 to $150,000 at 0%. But that's really predicated on your personal credit. No bank is going to loan a brand new business that has no type of maybe even financials, no tax returns, anything primarily on the business, anything substantial primarily on the business. But when you go the credit stacking route and you have a good personal credit score that, or not only the credit score, credit profile that has been optimized in the correct way, and you present that to an underwriter, then they'll say, okay, we'll give you a $50,000 0% card at Chase, or we'll give you a set. I've seen people get, some of my students get a $75,000 0% card at Chase. That's $75,000 for 12 months. That's marketing. That's your VA. That's merchandise. That's shipping. That's anything you need to really like grow and scale your business, especially if you have something that's already proven concept and is already working. Right?
Exactly. Already generating revenue.
So to answer your question, they're linked because it all starts with your personal credit. And I realized that a lot of people weren't able to access business credit because they just weren't at that 720. And what was holding them back was little small things like maybe a charge off, a collection. Maybe they had a bankruptcy, right? And they think that those are big things in their head. But because I have the knowledge and because I know what's possible, I then started to open up to them and tell them, hey, listen, I can help you fix your credit. Once you get it to that 720, then we can go and get the business funding.
Right.
You understand?
So that's where I'm at now.
Right.
As much as I've helped people with buying and selling homes, I, as a business owner, I now want to, like personally, I want to solidify my credit profile so that I can go ahead and leverage business credit for the benefit of my business.
Right.
So, where maybe we could do a series of some sort where we're documenting the process, kind of like a case study for your clientele, because I now want to engage with you in getting the process started, knowing that I have to fix my personal credit profile to qualify for the business credit opportunities you've mentioned. So where would I start now? Let's just say my credit score is in the high 500s, low 600s. I want to get to 720. Due to the fact that I'm in a new mortgage, I think the positive impact from that credit account isn't going to hit for at least the next 6 months or so. So I'm looking at a time frame of about early January. But I know I need to work on some personal items. So what do I need to do to get started?
So the very first thing I would do is I would do a free consultation with you. So on that call, it's usually about a 30, 45-minute call, and we go over every single line of your credit report. So anything that's on there that doesn't look familiar, you want to point it out on that call. But that way we get to see exactly what's underneath the hood. Like I always say, it's like you go to a mechanic shop. And something you just tell the mechanic, hey, something's wrong with my car. He's not gonna know until he opens the hood and then looks under the hood, and then he's like, oh, it's your radiator. Oh, it's this, right? So the first thing we'll do, we'll go over your profile so that we can see what you need, and then we start the process. You might need to remove some charge-offs. You might have some high utilization. We can either try to restructure that debt by getting you a personal loan, or if you have some cash available, you pay down your credit cards, right? You may have some late payments, so we can start the dispute process when it comes to that. The very first thing we like to do too is we like to go to your personal information on your credit profile and attack that first, because a lot of times you have like old information, old addresses, variations of your names. Like we like to clean that up for two reasons. The first reason is because that could be attached to charge-off accounts and accounts that we're trying to dispute off. Of course, yeah. Right? And the second reason is that when you present your credit profile to an underwriter, if it's nice and clean and it has your name once, how you have it, not different variations. It has one address, which is where you live, so they know where to find you. It doesn't have 5, 6 different addresses. It's a much cleaner credit profile. So when you go to get business funding or even a house or whatever the case is, it's much more easier to get approved when your credit profile is like, cleaner and more streamlined. So to answer your question, the very first thing that we'll do is go through your report, see what you need work on. The very second thing that we'll do after we start the dispute process and after we start getting some things off, start getting some results, is we'll start the optimization phase. We'll say, hey, okay, is your goal business funding? Okay, if your goal is business funding, how much money do you want to get? So let's say you say 100,000, 150,000. Okay, cool. let's check your credit limits to see how many credit limits you have. Like, what are your credit limits? Do you have any cars that's 10,000 or above? If you don't, okay, now that your score is higher, go and apply for this card, because we know that this card, the minimum that they will give you, like for instance, the Chase Sapphire Reserve card,
Right.
that's a Visa Ultimate or Visa Unlimited card, right?
Okay.
Visa Ultimate card. But anyways, the starting limit on that card is $10,000.
Okay.
So if you have a decent credit score, if you have a relationship with Chase already, we're going to push you to go and get that card first to build a relationship and build your profile. Okay. So that way, when it's time to go and get business credit, the underwriter sees, oh, he already has cars that are 10,000. He already has,
it's like a prerequisite.
It's like a prerequisite
for a larger.
Correct. Because the bank
limits.
is not going to give you $50,000 on a Chase card if you only have a $1,500 credit card,
Right.
or even 3 or 4 $1,500 credit cards. They want to see that you have high limits on your personal, and based on that, they're going to say, okay, we'll give you high limits on the business. Banks like to loan on the business because they can loan more on the business.
Correct.
But you have to meet the prerequisites, and you have to fit the profile.
Of course.
Right.
So now, I'm excited to see the app. I want to see the app. I want to see it from a consumer standpoint, and see how the updates work.
Yeah.
Because that's something that with either Credit Karma or Experian, like you have to worry about. I think there's another one, Credit Sesame.
Yeah.
You have to worry about either the inaccuracy of the scores, right? And then not necessarily knowing. I know because I've helped people with the credit repair process as well, but sometimes when you're looking at these apps, these free apps especially, and then you pull your credit report from annualcreditreport.com, you have either a mismatch or annual credit report. I don't think it shares scores, but it has accounts on there that are more accurate that you don't see on the other interfaces. So. I'm curious to see the app and see how it all works. Of course, getting the updates, and then seeing, where my journey is going to lead me. Because I definitely want to blow up the real estate brokerage. I want to leverage the business credit that would allow me to do that.
Absolutely, man. So 2 things that just popped in my mind. First and foremost, you mentioned that, because we have a lot of clients who use Credit Karma, Credit Sesame, things like that. And a lot of people don't realize that there's a difference between your Vantage score and your FICO score.
Right.
So banks are going to be using your FICO score. Generally, when you're getting your FICO score, those are the scores you have to pay for. Like if you go to Experian.com, to access IdentityIQ.com, you're paying for those. And there's a reason why you're paying for those, because there's value there. The banks are going to use that score to actually get you approved. But if you go on Credit Karma, a lot of people complain, oh, my score is so low on Credit Karma, or it's higher on Credit Karma.
Right.
That's usually because it's a Vantage score, and it's just calculated differently than how the FICO score is calculated. Right? So I just want to touch on that, because a lot of people don't understand that misconception.
Oh, yeah, 1,000%.
Right?
And in most cases, Credit Karma tends to reflect a higher score than your actual score. In some cases, it's accurate, it's spot on, and in fewer cases, but it is possible, it's lower. I have seen cases where it too, it's lower, it's significantly lower, and people are like, whoa, my credit score is way
and then
more than what
they
it
feel
says.
they feel a type of way. It brings an emotion. They start to feel like defeated. You know what I mean? Especially if they're working on it and they're let's say they're doing it themselves,
right?
And then they're following Credit Karma, and it just keeps going up and down, and they're not understanding what's going on. So I always recommend people to use My Score IQ, Identity IQ, or even we use Smart Credit a lot. But we use Smart Credit just for the disputing process. I wouldn't really recommend that for credit monitoring per se. But My Score IQ, Identity IQ, and Experian.com.
And in regards to your app is on the App Store, or like how does that work? Is it on both platforms, Android and iPhone operating systems?
So once we onboard you, we send you a direct link, whether you're on Android or iPhone. You download that link, and that link is actually attached to Smart Credit.
Okay.
So it's going to pull your score and all of your information from there, and then display it right there for you.
Very cool. Very cool. And is your app a paid app? Or
no. It's
a free app?
Yeah, absolutely free. It's only for clients who are working on their credit.
Okay,
Yeah.
gotcha.
We also have an app called the Optimizer app for business funding, where we help you optimize your credit profile and learn how to do it. But that's for the business funding side of things.
Okay.
Yeah, yeah.
And what is your time frame once you hit that 720 score? What is the time frame for the business credit?
That's
how
a great
soon?
question.
Yeah.
So it really just depends on your strategy. It depends on what prior relationships you have. It depends on how optimized your personal credit is. Because the first thing you want to do is just optimize, right? Go if you need to, because there's some banks that are relationship based, and there's some banks that are not really relationship banks.
Right.
Like Truist isn't really a relationship based bank. You can go to Truist and get $20,000 without even having a Truist bank account.
Right.
But Chase or American Express, they're more relationship based. So they want to see you have like a couple of their products first, see what type of person you are, and then they'll give you the bag. You know
Let's say
saying?
with American Express, right?
Mm-hmm.
With American Express, I mean, me personally, I've never had an American Express card.
Mm-hmm.
Does it make a difference if I have no pre-existing relationship with American Express and no accounts? Does it make a difference if I'm going to apply with them straight up? Or what if, let's say, a buddy of mine, which I have a lot of friends who have American Express, let's say they add me as an authorized user. Does that authorized user account has an impact on a relationship with American Express or no?
I mean, it might. American Express is, to me, they're very strict when it comes to who they let in in the beginning. Even me, when I first started with American Express and I applied for business cards, they gave me like super low limits. I'm talking like 500 and 700.
Oh, wow.
Right? But once you develop a relationship with them, then you can start to stretch really fast. So to answer your question, it may help, but it's like you get invited to a party,
right?
But then you brought a friend. It's like your friend could come in, but the friend didn't get invited. You got invited.
Yeah.
So you really want to put yourself in the position. Let's say you go in that way and you're added on as an authorized user. Let's say you get a small limit. Just build and develop that relationship with them over 6 to 9 months, and then start applying for like the 0% cards they have, or like the platinum card or the gold card.
So it's kind of like your friend can come in, but he can't get in the pool.
Yeah, he can't get in the pool yet. We don't know him like that yet. You know what I'm saying? So
he can't hit the keg.
He can't hit the keg. He can't do all that. So that's really how that works. But once you build those relationships with those banks, and I work directly with underwriters too, so I have inside knowledge as to what you should do in what sequence, right? Now, what people don't realize too is that banking is always changing. So what works today may not necessarily work tomorrow.
Right.
So what we do in that instance is we collect data points. So if I go in and do an application, or one of my students go and do an application, they'll let us know, hey, this is what I put on the application. This is how the application was. So we have a community of just data points that's building and building and building, which gives us information so that we can make educated decisions when it comes to applying at different banks.
Right.
Does that make sense?
Right. That makes perfect sense.
Yeah.
Now, the thing that you mentioned, a key term, credit stacking, right? So credit stacking is, I'm assuming you get one line of credit, then once that goes through, you get another line of credit, then another line of credit.
No. So credit stacking is the process of accumulating credit cards and stacking them up. Now, the reason...
Break that down for me, because does that have anything to do with like knowing which creditors look at which bureaus?
It does.
Okay.
Yeah. And the reason you want to do that is because revolving credit is the easiest type of credit to get, especially for new businesses. New businesses don't have tax returns. They usually don't have that much cash flow. They probably just started, whatever the case is, but they still need capital to grow. So this is just the way banking works. They allow you to be able to get credit cards quicker than you'll be able to get a business loan or business line of credit. Now, in order to credit stack efficiently, you do need to know some things. You need to know which bureaus certain banks are going to pull. So that way you can maximize and say, all right, I'm only going to go for cards that pull from TransUnion or Experian. Right. So you can maximize, what you're going to be going for. Because once banks see that you're actually trying to get credit cards and stuff, and you have a lot of inquiries, they're going to start denying you. Right. So there's strategies around that. But to answer your question about what credit stacking is the process of stacking up 0% interest business credit cards as high as you could possibly get. Let's say 100,000, 150,000, 200,000 on a particular LLC. It could be a brand new LLC. It could be an aged LLC. It doesn't really matter. And then you can liquidate that money into physical cash to be a down payment for a house or buy whatever you need.
Right.
Or you can use the cards and then rack up a bunch of travel points where you can then start to travel for free. So there's benefits to using it. And the best benefit to me is that once you use the money in the correct way and pay back off the cards, the bank is going to say, oh, okay, you know how the game is played.
Right.
All right, so let's do it again.
They're going to reward that.
They're going to reward that, right? So then you get larger limits, and you get, you can get it on multiple other LLCs, and you can really, use that money to invest in any type of opportunity that you find.
Right. So do you, with businesses that already exist, we tend to be judged with our credit based on behaviors and patterns. Like, do you do any kind of business planning to go along with, like, hey, once you get access to these funds, what are you going to do with it?
Right.
Like, are you really in it for growth, or are you just trying to gain access to funds to blow it and do it all over again?
See, and that's a very, very important question, and that's something that we've been kind of implementing to the community, because there are some safer routes and things to do with your business funding, right? Such as, purchasing a business, laundromat, car washes.
Right.
These are businesses that are going to be sustainable throughout ups and downs of an economy, right? But what's the most important thing is understanding the metrics of the business, and then maybe having a controller. I don't know if you're familiar with what a controller is.
Not necessarily. I can guess through context, but tell me more.
A controller is like, so you have your CPA, you have your accountant, but a controller is the one that really gives you the metrics needed to grow a business.
Okay.
So they'll break down exactly what you're spending on all your different categories, and then they'll say, all right, let's create a plan for growth. And this is the financial plan for growth. If you do this, then in a year, we'll project that you will do this in revenue or that in revenue, whatever the case is, right?
Okay. So they kind of have like a formula.
Yeah, they have like a formula, and you can get what's called a fractional CFO. Is another thing that you can get to.
Yes, I've seen that.
Right, and they're great at the numbers. So because as an entrepreneur, first of all, you can't do everything. Right,
1,000%. I'm learning that the hard way.
You can't do everything, and people don't realize the quicker you can build a team is the quicker you can actually make some real money as an entrepreneur. But we're always kind of scared about building a team. But build a team quickly.
Yeah, I can't. I'm the best at doing this. I have to do it.
I have to do it
all.
Yeah.
I have to wear all these hats.
I cringe whenever I hear people say that, man, because they come up with all these things in their head, and it's just like, no, you're not the best. There's better people out there at taking photography or making t-shirts. Let them do what they love to do, and you focus on overseeing the entire machine.
Yeah, I even cringe when I say it myself, like, oh no, I can't let such and such do it because I got to do it first. I'm like, I be catching myself all the time, especially now. I'm like, oh man, I need to erase that thought.
Yeah, I do the same thing too, bro. Same thing. But yeah, so we invite people to to certain investments, things that are going to be profitable, things that are going to be sustainable, things that are going to pay back in time for your 0% period. Right. I call that 0% period your runway. Like when a plane is taking off, right? You want to get off of the runway before you crash. Right. So you want to find investments that you can invest in and then pay back off and then do it again.
Right. Yeah. Like when we met, when you told me the whole concept about your car rental business, I thought that was genius.
Yeah.
Because
thank you.
It's essentially it's like ghost money.
Yeah.
Right.
Yeah.
You get access to funds. You leverage it to get your business running, and by the time you have to pay those funds back, the funds coming in is covering the cost of that.
Correct, because you're not paying any interest.
That's the ultimate hack.
Ultimate hack, bro. Because you're not paying any interest. And the thing is, like, if you get, let's say for instance, you get in a situation where, let's say something happens within that 12 months, and you need an additional 3 months. Right. You can always use other 0% cards and do a balance transfer and get another 12 months. Right. Or you start going up the line of products that the bank has now. So I was with Chase. I had a $50,000 card, whatever the case is. All right, now I can go to Chase and get a business line of credit because I've showed them over the course of time. I pay on time. I don't miss payments. I paid back the cards. Let's say you paid it off in full, whatever the case is. And now I also have revenue. I should have tax returns at this point now. And now it's easier for me to go to them with paperwork and say, hey, I want a business line of credit, which is going to be cheaper money than a revolving account. You see what I'm saying?
Okay.
And then you can do whatever you want to do from there. The sky's the limit from there.
Right. And that business line of credit, I'm thinking of it now, like a home equity line of credit. So the business line of credit, is it similar to a credit card, or how does that work exactly? Is that like, let's say you get approved for a business line of credit, those funds are going into your account?
Yeah. So it's kind of like a credit card, but you only pay on what you use. So let's say you get a $50,000 business line of credit, it's going to show on your account as $50,000 is there, right? When you transfer, let's say $5,000 out, you're going to be paying interest on that $5,000.
Okay.
When you pay it back to the business line of credit, it goes back to $50,000.
Okay, so now you transfer out $5,000. You have $45,000 that you have access to, but you're not paying any interest on.
You're not paying any interest on it because you're not using it.
Interesting.
Yeah. So it's only on what you're using.
Okay.
Yeah.
That's pretty cool. I did not know that. At all.
Yep.
So what are the most I guess, being that you didn't want to quote unquote sell the dream, what are the quickest results that you've seen for someone from let's just say they've already got 720 credit score? What's the most amount of business funds they've gotten access to?
Oh, you could get
in what amount of time?
You could get 100,000 in a week.
Okay.
I personally got 100,000. Now, it took me, see, the time comes with the optimization. If you have a fully optimized profile, because that's where the patience comes in. You want to get your limits high. You want to make sure your utilization's low. You want to remove any inquiries by going through the credit repair process. But then once you get to that point, it's like, and you're ready to pull the trigger, you can go bank in a week and get all your approvals and have 100,000 or 150,000 in a week.
Wow. Wow.
Yeah.
That's swift.
Yeah.
That's swift. So assuming your profile is optimized, now what does that optimization process look like as far as timeline goes?
That's a great question. So like I mentioned before, I have relationships with underwriters. I have relationships with other people in other communities as well. And we have a lot of different data points for all the banks around the United States. So we know what is the ideal setup for a bank, down to how many accounts you had open in the last 6 months, how many accounts you had open in the last 12 months, how many inquiries you have, all the little nuances and little details. So we optimize for all those things. So an optimized profile would be a profile, just to give you like an example, a profile that has collective credit card limits of roughly about 100,000. You don't want to have too high of personal credit cards limits to you.
Right.
Because that also is risky to the lender.
Limits or balances?
Limits.
Or just limits?
Limits.
Just limits in general?
Like I have a client who has like $300,000 in just collective credit card limits.
Okay.
That means
even though his balances
are low.
Are low.
It's low.
Okay.
But you got to think about it from the bank's perspective. It's still a risk, because if we start giving you more money on the business side, and let's say things don't work out, now we got a risk of 300,000 on the personal side, as opposed to being a risk of 100,000 or 50,000.
Gotcha.
Right. So in that case, you might want to you definitely want to lower your limits to like the $100,000 range, and you'll start to see your approvals on the business side start to go up. So that's an example of optimizing for that. Of course, you want to optimize for utilization. You definitely want to be as low below 30% as possible. Ideally, you want to be at 10% utilization
10% or lower,
on all your cards. All right. You don't have to really worry when you start getting business cards. You don't have to worry about utilization so much on the business side, but you want to keep it low on the personal side. Like I mentioned earlier, comparable credit. So that means how many cards do you have in the double-digit range? So 10,000 and above. The more you can have of that, the better, because that's going to help them say, okay, he has 10,000 on personal. We'll give him high limits on the business. Right. What else? Oh, the number of credit cards you have too. So you don't want to have a thin credit card profile.
Right.
You want to have at least 5 credit cards in your name, not authorized users.
Personal to you.
Yeah, personal to you, not, somebody invited you. Like, you want it to be personal to you.
You want to get the invitation to the party.
Exactly.
Now, is there a difference between, let's just say, it being a secured credit card or an unsecured credit card?
Yes. So there definitely is a difference. Number one, the difference is going to be the limits, because most secured credit cards won't let you do more than $1,500, which they have the reasons what the case is. So the limits is definitely going to be the issue. And then unsecured is better because it's like having your training wheels when you have a secured credit card.
Right.
So you're not really proving that you're not risky because we already have your money.
Right.
If you do default, we just take the money that's there. But can you do it for real? Can you ride the bike without training wheels? So having the ones without having cards that are unsecured is definitely better. Helps your profile for sure.
All right, so a minimum of 5. That's good. That's minimum good to know. 5.
Yep.
Yeah, I didn't know about that.
And the thing is too. So people are always like, well, how do I get these high limits on my cards? And there's 2 ways that you want to go about doing that. So the first way is you want to do credit limit increases every about 6 months on your cards.
Okay.
Most people don't do that. You want to ask for them, and usually the general rule is to ask for 3x of your current limit.
Okay.
So if you have 500, ask for 1,500.
If you have 1,500, ask for 4,500.
Right.
Okay.
Sometimes they'll match you, or they'll hit you with that same limit, or they might come a little under or a little bit less. But
it also depends on where your current balance is too.
And it also depends on where your current balance is.
That weighs in on their decision.
Correct. So you have that, and then also, and this is a major gem, when applying for credit, a lot of people apply in the wrong way. So credit card applications are based on what's called stated income.
Right.
That means that it's not verified. Now, that's a good thing because that gives you a little bit of flexibility. Even on the personal side, for income, it says household income generally.
Right. So you don't have to put your income per se.
Not only your income. You can stack your household income. So if you live with your mom, your sister, your brother, and y'all are all making, let's say, your spouse, and y'all are making all $40,000-$50,000 a year, that needs to go on your application because that's how you get the higher limits.
Right.
It does say household income. It doesn't say your income.
Wow.
It says
I never caught
income.
that.
A lot of people don't catch that.
Right.
So you want to optimize for that to get those limits to be higher. And then once those limits are high, like I said, you just want to keep the utilization low.
That makes sense.
Yeah.
Wow. That's a good one. That's a good catch. Household income.
Household income.
Personal income.
Not personal income. Yep.
I got the brokerage and we have the official printer. So this is when I was transitioning out of Compass and going into opening my own office, I wanted access to a similar printer. We got the Ryco printer, and the gentleman who was helping me with that process, he was guiding me along with the application, and we attempted to do it to where I applied with the business, with the entity, and did a personal guarantee on the application.
Okay.
That did not get approved.
Okay.
So then we used one of my older entities as what he referred to as a cross corporate guarantee.
Okay.
So that method actually got me approved.
So if I understand,
so I guaranteed. Go ahead.
So if I understand correctly, the LLC guaranteed the other LLC.
Correct.
Huh.
Correct. One entity guaranteed the other. The S corp entity guaranteed the LLC.
That's interesting.
And got me approved for the industrial printer.
What was the amount for it?
Roughly around, I think it was like a $26,000 lease.
Okay.
Was the value on it?
So the first entity, the LLC, was stronger then?
No, the first one was newer.
And
it couldn't get approved on its own.
And how old was the other one?
Was about, I want to say, 4 years old.
Okay.
So that length of time plus whatever accounts I had on that one was able to be used as what he referred to. Again, this was a new term to me at the time. I think we were talking about it at the time that it happened because it was a fresh experience for me.
Yeah.
Because I never had, I've had a basic printer at the house and stuff, but when it came to that machine, I didn't know it was possible. It's like not knowing that you can buy an ATM machine, right?
Yeah.
So I didn't know
yeah.
what was possible to have one of those big printers at the home office.
Yeah.
But when I went through that process, the key term that I learned in that process was the cross corporate guarantee.
And see, that's the thing too. Like banks have so many. There's so much about the banker world that we just don't know, and we will never know because realistically, they can't come out and tell you everything or like show you how it. There's secrecy. There's secrecy there for a good reason, right? Now that's even something that I haven't thought about, but that's now a data point. Because if that can happen, I need to understand, what the bank was, what risk, what risk factor that alleviated for them to make them want to give you access to that capital. Because $26,000 is a decent capital line.
That's right? A decent value.
Decent value, correct.
Plus, the gentleman who was helping me with that process, he had mentioned that he has seen, I want to say Marriott get declined as a client to that lender.
Right. So that goes back to all the risk factors. That's what I think people don't realize. Like banks are just in the game of reducing risk.
Correct.
As much as possible. So in that situation, you're less risky than Marriott.
Right. In that example. Yeah.
In that example. So that just shows you like what's actually possible once you start to understand how to utilize, because it all comes down to credit. And what is credit? Credit is just really how risky are you with money?
Right.
How much do you know of the game of money?
Right.
Because if you know a lot about the game of money, yes, you might have a lot of money, but if you know a lot about the game of money in banking and finance, then you'll have a lot of money and a lot of credit. Or good credit.
Good credit.
Say.
Right. Of course.
So that's really interesting, man.
Yeah,
that's some really interesting data points for sure.
Yeah, and that would be something for us to observe closer to see, keep our eyes open for opportunities that would allow us to share that with other audiences and help them in situations where maybe they can't personally guarantee something that they need access to. At that point in time, I was losing access to that tool, right? That printer as a tool, and needing access to it. And that golden nugget that salesperson opened and gave me insight upon gave me access to that tool where I didn't compromise, the level of service that I'm able to provide to my clients.
Yeah, absolutely.
Which is cool.
How often do you run into people who are looking to buy a house where like their credit's lower? I know you said that you work with people who have like the lower credit, but how often is that compared to people who actually have good credit?
Well, that's a very good question because I'm going to be honest with you. It's not very often. When people say, yes, I want to move forward, I tend to find that they're actually in a better position to buy a house than they thought they were. So it's the ones more so that they're holding themselves back from moving forward in the process because they think their credit score has to be X in order for them to qualify, or they think they have to be at a 720 in order to. So it's not true. I mean, on a FHA loan, your credit score can be as low as 580. Right. And there are certain lenders who I have access to now who can work with credit scores as low as 500.
But is it beneficial for somebody to buy a house at a 500 credit score, or should they go through credit repair first, like ideally?
In my opinion, yes. Right? I would say, especially with everything that I learned going through my own process, I would say the sooner you can buy a house, the better, right? Because again, your credit is going to improve when you're paying a mortgage. Not necessarily the case. I know now they have the credit programs that are counting your rental payment as part of your credit score, but those are new programs that are rolling out. They're not yet as reliable. But paying off a mortgage is going to benefit you more than paying your rent. So if it's going to make a difference between buying your house and closing on it within 30 to 45 days versus waiting for your profile to be fixed within 180 days, I would say close on the house. Make that payment after 6 months of on-time payments. Your credit score is going to improve significantly.
But in that situation, when when are they able to like refinance?
Correct. So you can refinance on a home in as little as 6 months after closing on it.
Okay.
So that's two factors. That's what I was gonna say, was that you can refinance on your home. Let's say interest rates improve and or your credit improves within that time, and you can access a better rating at that time because your credit has improved. Then it only takes as little as 6 months to have the opportunity to refinance.
Gotcha. Interesting. Okay, that's good to know. And I'm sure there's a lot of people out there who probably don't think they can refinance.
Yeah.
Or probably don't even try to refinance.
Or they think it's going to take a couple years before they can.
Absolutely.
But the truth of the matter is, you can close now, July 2025, and if the interest rates drop by 2 points in January of 2026, if it makes sense for you to go ahead and refinance, you can refinance.
Gotcha. Okay, that's good to know. All right, so what's one real estate myth that drives you crazy every time you hear it?
All right, so aside from the credit score one, definitely the down payment one.
The down payment.
Definitely.
Okay, what do you mean by that?
Because most people are under the assumption that they need 20% down.
That's true.
Right?
That's true.
So if you think that you need 20% down and you're thinking in terms of 100,000, 200,000, 300,000, right there,
that's a lot of money.
You think you need $60,000.
Yeah.
So most people are not even going to blink twice at the thought of buying a house if they've only got $10,000 in their savings.
Right.
But if I tell you you can buy a home with 3.5% down, and now you're thinking in terms of 3.5%, that's $10,500 versus $60,000. So if you have $15,000, and in the case now where sellers are more inclined towards contributing to the process, right? And
because it is a buyer's. Is it a buy? Would you say it's a buyer's market in like Orlando and Florida now? Right
now, I would say it's definitely even nationwide. It's definitely swinging more towards the side of I think we're still in a balanced market because homes are taking between 5 to 6 months to sell.
Okay.
But we're definitely swinging. See, when I came into the industry back in 2017. We were in a balanced market. Homes were taking about 6 months to sell, but we were swinging down towards the seller's market.
Okay.
Right? Because sellers were getting more and more ballsy about, not wanting to sell or not wanting to accept an offer, knowing that better terms and conditions could come along with the next buyer. Right? Now it's more swinging. The pendulum is swinging the other way around because it's like, both listing agents and sellers are anticipating somebody to come through the door and say, "Hey, I want to pay full price. I want the best terms and conditions for the seller," but that's just not happening, right? One, buyers are not wanting to pay full price. Two, they're wanting the best terms and conditions for themselves, especially if the home is not necessarily turnkey.
Gotcha.
Right. What about for yourself? What is the number one myth?
So all right, so there's two number one myths for me in credit. The number one myth that I think in credit is that you have to pay off your debt.
Oh, yeah.
That sounds crazy to some people.
Yeah.
Like if I say you don't have to pay it off, they're like, what? What do you mean I don't have to pay it off? Like, where does it go? Right?
Yeah.
But it's just because they don't really, and they just don't understand like how the financial game works. When somebody charges off your account, the bank has already accounted for that loss. Number one, they've already gotten a tax benefit. In some cases
they've already written it off.
And sometimes they get an insurance benefit from it as well.
And they sold the account to another.
And they sold for pennies on the dollar, and then they're coming after you because they know that you don't know better. So then you end up paying it, right? So I think that's definitely the number one misconception on the credit repair side. Oh, another one is people don't think that they can get they don't know that they can get their inquiries removed. Right? A lot of times we can get inquiries removed, and it's a relatively easy process. It's not that difficult. And then on the business side, I think the biggest misconception is that
probably the capital factor, the fact that you can access capital with a brand new LLC.
That's a good one. Yeah, people are always think that they won't get a lot of money from banks if their LLC is like brand new.
So they'll think they have to save up X amount of dollars in order to start a business.
Yeah, they'll actually think that they also need cash flow. Because you don't need necessarily, I mean, cash flow definitely helps.
1,000%.
But you don't necessarily need as much cash flow as they think that they need to be able to get large amounts of business credit.
Right.
It really just boils down to, like I said before, optimizing your personal profile, and then also applying in the right way, building the right relationships, and then there's one more I'm missing. Optimizing the right way, building the right relationships, and then I'm going blank. Yeah, but that, I mean, that's pretty much it.
Yeah.
Optimizing, applying in the right way, knowing what NAICS code to use.
Ooh, that's a big one.
That's a very big one.
That's a big one. I remember when, this was with the original S Corp that I had, and I didn't understand what an NACIS?
No,
or
NAICS. Yeah, NAICS.
I didn't understand what that code
North
was.
American Industry Classification Standard.
Okay.
Yeah.
So I was with Chase Bank, and when she asked me what my code was for her to register my business bank account, I had no idea what she was talking about.
Exactly.
It was like my maybe fourth or fifth or sixth business that I've ever registered.
Yep.
And I didn't know. It was I want to say it was probably my first business bank account that I was opening.
Right.
And that was the first time I was asked that.
Yep.
So
most
I had
people
no idea.
most people have no idea, and what happens is that they just kind of choose something that just sounds right, but they don't realize that decision right there has messed them up when it comes to funding. Because if you're in an industry that the banks see as high risk,
correct.
It doesn't matter what you put on that application, you're going to get small limits. But that's why I said before we collect data points, because these things are always moving. Like, for instance, an NAICS code that used to be very lucrative before was consulting. Right, that was like the main one that we used to use. But now banks are starting to see that like everybody's got a consulting company now.
Right.
So
right. They caught wind of it.
They call wind of it. So the goalpost is always moving, and that's why data points is important. But yeah, a lot of people do that. And the crazier part is that the people in the banks also don't know how important that is, because they'll say, all right, let me help you. All right, well, what do you do? Da, da, da. And then they just like put it in there.
They think they're guiding you.
They think they're guiding you.
But it's not really to your benefit.
Correct. And they don't know, because they're not in the funding space. They're not an underwriter, right?
They're just bankers and processors.
They're just bankers and
information processors.
And that's why actually applying through a business relationship manager is beneficial too. Because when you apply through the relationship manager, there's a different underwriting process. It includes a DocuSign most of the time, and there's a more human connection. Because most time if you're applying, well, all times if you're applying online, you're just dealing with algorithms. It's computer to computer.
Right.
But a business relationship manager will ask you questions about your business.
Help you help understand your goals.
Help understand your goals. And usually when we send people to our relationship managers, they get much higher limits because they're going through the relationship manager. That's how you get those $60,000, $75,000 cards.
Right.
As opposed to getting maybe a $10,000 or $20,000 card.
Right.
Yeah.
That makes sense.